Ladies and gentlemen, Mr. Munot, and our next panelist is Mr. Sundeep Sikka. He's the Executive Director and CEO of Nippon Life India Asset Management. He's a Chairman of Association of Mutual Funds in India, AMFI. He joined Nippon Life in 2003, holding various leadership positions, and before being elevated to become the CEO in 2009, one of the youngest CEOs of India. He has been responsible for the growth of the company and for forging a relationship with Nippon Life, acquisition of Goldman Sachs Asset Management India, and listing the company on stock exchanges. Ladies and gentlemen, Mr. Sikka. Our next panelist on the session is Mr. Vetri Subramaniam. He is the Managing Director and CEO Designate at UTI Asset Management Company Limited. He joined UTI AMC as Head of Equity in January 2017 and assumed the role of Chief Investment Officer from August 2021. He has over 3 decades of work experience, and prior to joining UTI, he was the Chief Investment Officer at Invesco Asset Management, where he was a part of the startup team which helped establish the firm's proprietary investment process and the team. He has worked with Kotak Mahindra, SSKI, and Motilal Oswal. He was also one of the founders of Sharekhan.com, now Mire Asset Sharekhan. Ladies and gentlemen, Mr. Subramaniam. Our moderator for the session is going to be Mr. Sikka. So over to you, sir.
Thanks a lot. Good evening, everyone, and thanks for having all of us. I think all of us from the mutual fund industry were thinking we are used to having an audience because everybody's from the mutual fund industry. But today we have a panel which we know I think we have to talk very different language because today we have and the topic and the theme is very different. But it is very apt for the mutual fund industry. So let me start by, while the introductions have been done, I think what we'll do is 3 of us, starting with Navneet, myself and Vetri, we'll give some opening comments. I think we'll go for some question answers, So Navneet, over to you.
Oh, thank you. And thank you, Mr. Damodaran, for having me. It's such an honor and pleasure to be part of this. And this is so pleased that the 10th edition of Gatekeepers of Governance. And I get reminded of Mark Goyder of Tomorrow's Company that leadership and governance are like the yin and yang of the organization, of successful organization. If you have leadership without governance, you risk tyranny, personal fiefdom, fraud. And if you have governance without leadership, then you risk atrophy, bureaucracy, indifference. And that's why it's very important that you have both, and this is what you have been passionate about. This is what you've been doing for several years and doing a great service, of course, to all of us as investors, but to the corporate India, to the economy and to the society. So it's such a pleasure to be part of the 10th edition. Over the last several years, while we have been investing for a long time, but as an investor, we have seen the evolution of corporate governance over the last several years. Thanks to New Companies Act, thanks to what SEBI has done in terms of LODR, thanks to many other things that have happened, things that you have been doing, people like you have been doing, the whole ecosystem of proxy advisors, and many other changes that have happened in terms of what investors are doing. I think we have come a long, long way relative to where we used to be. I take deep pride looking at this topic. I was very pleased that in 2014 or so, in my previous organization, along with one proxy advisory firm and CFA Society and CFA Institute, we published a shareholders guide. I think in the first edition we called it AGM guide, and then we called it like more appropriately shareholders guide, which was basically enabling investors or as part of like investor education that what are your rights and the responsibility when you are shareholder of a company, a minority shareholder, what rights you have and what responsibilities you have. And now it's almost like 10, 11 years and I got reminded of that. We have seen, we have come a long way. So the topic is like individual and the institutional shareholders. there are institutional shareholders and there are institutional shareholders. There are individual shareholders and there are individual shareholders. So you can't have a simply you cannot put them in like two buckets. There are individual shareholders who have been owning a company, a business like an owner. They may be a minority shareholder, maybe owning a few hundred, few thousand, or maybe a 0.1% or 0.001% or couple of percentages of a company. And there are shareholders who are owning it for months, and in fact these days for days or maybe a couple of hours, or in fact there is a whole new breed of investors who are holding it for a couple of minutes, and now you've got the algo traders who are looking at a couple of seconds, and then you have algo traders who are looking at a couple of nanoseconds because the trade is going every second. And on the institutional side also you have variety of different investors. There are investors like us who think like an steward as in like we act as a steward of our unit holder, of our investors, and act as like owner of the business, while there might be different kinds of institutional investors, and there is rising influence of so many of the hedge funds who are only looking at like selling maybe next day or maybe a next month or maybe within few months. There are different kinds of, as I said, institutional investors also. As far as institutional investors like mutual funds are concerned, again, credit to our regulators and of course credit to our industry. We always take pride and we have been on the board for some time of MFI. We have been volunteer for a long time of MFI, that we take pride in co-creation of regulation, take pride in collaborating, take pride in cooperating for betterment of investors, for betterment of markets and improving corporate governance. And I think it was almost 2010-11 where SEBI asked us to start voting. And then after a year or two, they realized that large number of institutional investors were still not voting. And then this SEBI said that you have to disclose all your votes. And then people saw that there were large number of resolutions where you were abstaining. And then SEBI put another thing, I think in a year or two, that you have to put a rationale for each and every voting decision. And that made a lot of changes, because after every quarter it opens up to public at large. You see in media carrying reports in terms of the resolutions that have been voted for, voted against, where mutual funds like us abstained. And then a big leap was in 2020. It was, I think, came out in 2019, but as an industry we all got together and put a process in place of implementing the stewardship code. So we all now abide by the stewardship code, which are like 6 pillars. You have the stewardship policy, your policy and process on monitoring of your investee companies, engagement with your investee companies. It's voting and voting policy and the whole voting process, managing the conflict of interest, and disclosure of all of this in public domain. And all of this you can go to like our website and can see what we are doing on the stewardship code. So one is the code, policy, process, and the actual implementation of all of this. So we have come a long way as institutional investors. We have come a long way, and it's very interesting. I remember 2 or 3, and I had the deep honor and privilege of chairing SEBI's first ESG committee, and now it's become the ongoing ad hoc committee. And I mean, when we were comparing ourselves on many parts, I mean, I won't talk about the E and S, which is not the topic today, but on G with many other parts of the world, and we really took pride in terms of where India is relative to several of the developed countries, as well as many other emerging countries. I think India would be one of those few where we started voting on 100% of our resolutions, whether I own the stock in an active fund or in a passive fund, where it's more like just if the stock gets added in an index where we don't have an active view, but we still act as a steward, because ultimately during that period, the unit holders are owning the company through us. On the individual, and the result of all of this, the awareness, larger discussion in public at large, and thought leadership forums like these, the result of this is last year and this year, 50,000 resolutions have got voted. And 4.4% of them, like 2,200 at last count, if I remember, have been voted against by various investors. That would include both like institutional as well as individual investors. Since post-COVID, little over 350 odd resolutions have got defeated. In fact, I think almost 60 of them in last 1 year. So it's not that India always say that we are a minority shareholder. There is always a controlling shareholder. It could be a family, it could be government of India, it could be a multinational, and now increasingly you are seeing a private equity or venture capital, but our voice is getting heard, and I think it gives us more empowerment. And there are, very interestingly, there are a couple of resolutions where they've got defeated, where actually it was not institutional shareholders because their ownership was less. It was more by individual shareholders who voted against. And the next stage, but I always say this, it's not a pride for us when we disclose this data, we all have to disclose. I mean, the number of resolutions we voted for or against and whatever. But the real pride would be where none of us have to vote against because we have taken governance to that level by constructive engagement. The more important thing is, recently you might have noticed, and we won't take the names of the companies, where I think company wanted to do something and there were lots of comments in social media, etc., and company decided against it, just like last week. And you are seeing more and more instances of that, and that's what the real democratization, that's what the real, I would say, empowerment of minority shareholders, where it's not only the compulsion that you have to vote, but it's the conviction that our voice would be heard, and our voice should not be taken lightly. Maybe there are a few more things to discuss, but I just thought I'll put across a couple of these points. And I see that the shareholder is picking up more and more over a period of time. And Mr. Damodaram, thanks again for putting this together and gives us more force to us. Thank you.
Thanks, Navneet. Thank you very much. No, I think, Vetri, before I come to you, I think it's also, I think since all of us represent the mutual fund industry, I think it becomes very important to understand, I mean, the mutual fund industry today has been growing. And today we have roughly, as a mutual fund industry, we represent 6 crore investors. Now, these are 6 crore retail investors who are very small investors, and today mutual funds giving a voice to them. So let me give you a little perspective, I mean, the pace at which the mutual fund industry is growing, we are 6 crore investors, the Demat account holders are about 21 crores people. Now, the topic given to us is very interesting. Are the interest of institutions and individuals, are they aligned, identical or not? I think, while I think we can get into a debate for hours and hours and days, the reality is the interests are aligned, interests are identical. Somebody may be feeling the need of that today, and somebody may not be feeling the need of that today. To give a perspective, today as a mutual fund industry, there are more than 300 companies where the single mutual fund holds more than 5%. There are more than 200 companies where a single mutual fund holds more than 7.5%. There are more than 150 companies where 3 mutual funds are holding more than 15%. Now, in a country where promoters are holding the majority, this is the power that mutual funds have at this point of time. And this is what is going to change. And as Navneet rightly mentioned, there are times, I think we get, today, firstly, I think I would like to compliment the regulator for pushing and nudging us. Everything across the world is evolving. Even the mutual fund industry is evolving. Today, the regulator has nudged us, pushed us that we have to vote, and also till some time back, we could abstain. Now we can't even abstain. We have to. As recent as, some time back, as a mutual fund industry, we had this. When we invest in foreign stocks, we had the luxury of not voting because we don't understand certain things. But now the regulator has made that also compulsory. So it's very interesting how things are evolving. And I think, I personally believe, this is a platform, where when more we discuss such things, more basically it is helping the entire industry, helping every kind of investor, and helping the corporate India to go up the curve. So I think broadly, completely agree with Navneet. I think what he said, I think it actually reminds me of a very different, moving outside the financial sector. Many of us, have heard the name of a shoe company, Nike. Just like mutual fund investors, individual investors, many times they only go for returns. But I want to give an example in Nike what happened, nothing to do with corporate governance, or financial. For the first time, it got exposed that there was a lot of child labor working in Taiwan, which was manufacturing these shoes. And there was so much backlash that I think basically the Nike started losing its market share. The reason why I'm giving this example is corporate governance practices are exactly, many times people just look at the product or the returns. But what is happening behind the scenes is equally important, because from a long-term point of view, that is basically what's going to define what is the future success. And that is exactly what the mutual fund industry through proxy firms and with the help of the regulator are trying to take corporate governance to the next level. So with that, I think Vetri, I think would be happy to have your views on this,
Sure. Thanks for that, Navneet and Sundeep. So, governance is a very difficult word to define in a comprehensive way. But one of the things that I experienced when I started out as an analyst more than 32 years ago is that the absence of governance is very acutely experienced by anybody who has ever held shares in a company. So hard to define all the positive elements, but the absence is like a pebble in the shoe, and it will always hurt you, it pinches you. If I were to sort of add on to some of the points that Navneet and Sundeep have already brought forth, and the context of the topic, the way Mr. Damodaran has defined it, which made it even harder to sort of think through the perspective. One simple way of looking at this is how involved are institutions in voting, and I think Navneet has already touched on that. If you look at the Indian data, and this has been widely compiled by IAS as well as the other sort of proxy advisory agencies, institutions today typically end up voting 90 to 95% of all resolutions which are put up for voting in companies that they own. If on the other hand, you look at the category of others, right? So in India, you've got promoter, you've got institutional, and then you've got others. So others includes retail, but it also includes certain other groupings, let's say a corporate body which is not a promoter, so on and so forth. If you see the data for the last 5 years which IAS has compiled, the average voting by such shareholders who are qualified as others is only between 13% to 18%. So they have shares in the company, but only 13 to 18% of those shares are actually shareholders are effectively coming forward and casting their vote when any resolution is there. So I think as institutional investors, it's been a journey to the point Navneet made when we started in 2011, and then gradually it became compulsory. And all of us have had to build processes and teams to support this, because it was not something which came intuitively to the mainline analysts who are focused on picking stocks. So we had to build the whole system of support, bring in people who would be governance experts, made sure that they would create standardized frameworks. Because if you're an institutional shareholder, it's very easy to say, I will judge every company and every set of resolutions based on what I feel at that point of time. But as institutional shareholders, we don't have that liberty. We can't determine an executive compensation policy for one company differently from what we would determine for another organization. We can't determine the ESOP policy for one organization differently from how we would determine it for others. So the big task that we first had many years ago was to try and create a standardized platform that we could first of all apply across the board, and further distill it down to a sectoral level, so that given the nitty-gritties of each sector, each industry being different, sometimes that can get reflected in some of those voting decisions that you are, have to take in such companies. So I would say the second level where having institutions play a very different role is not only that we are active in our voting decisions, but we also bring in a level of standardization which also help companies in turn, because then the companies also start to appreciate that, okay, when you all are voting, you all have a certain process. So we've actually had instances where companies come to us and say, we've spoken to IAS, we've spoken to SES, we've spoken to InGovern, but can you also give us an idea of the framework so that when we bring any policy, we know what is the information you are looking for, we know what is it that will typically guide your decision, because we want to be known as a company who's well governed. So I think that leads me to the next point, which is not only are we more active in our voting decisions, there's a significant amount of engagement which happens with companies. And this happens in all circumstances. In some cases, it is proactive, where a company comes to us and says, and we had this quite a bit, recently there was a spate of companies, who were sort of modifying their ESOP plans, and they had spoken to, the proxy agencies. They spoke to many mutual funds to understand what is your thought process, and by the time they brought their resolutions for voting, I think they'd already taken into account a large number of the thought process or what the industry was looking for. So we are able to engage with companies in terms of driving best practices. We are also able to engage with them when things go wrong. So I recollect about 3 years ago, one of the companies we were invested in, and they have a sort of web-based business, and it got identified by somebody that there were certain products on their website which, let's say, should not have been there for sale. This got picked up by an outside agency. The company said, yes, we are doing something about it. But we went to the company and said, look, this is not acceptable. You've got to find a better fix. And I'm glad to say that based on our engagement with the company, they finally went back. They put in place a much tighter audit process. I'm sure it's not 100% efficient, but a much tighter audit process, which then made sure that any of those controversial products were never listed on their website for sale or were never listed for something in which buyers and sellers could participate. So, that's just another example of where I think as institutional shareholders, we can engage with companies to drive certain behaviors, drive certain practices, which honestly, individual investors in many cases may not have agency to even engage with the company. So I think that's again a very critical difference in terms of how we as an institution are able to, engage with companies for positive change. And again, just to give you another example where again, I think, very proud of the fact that our analyst who, works on E&S, along with the people who work on the governance factor and the sectoral analyst, actually worked with a whole group of companies in a particular sector, which is highly carbon emitting. And what we did over there is we went to the company and said, hey, we rather went to all 5 of the companies in the sector and said, hey, here's the most efficient company in India in terms of efficiency, the power it uses, the greenhouse gases it emits. Here's the global standard. And we went to each of the companies and said, what are you going to do to try and transition there? Because irrespective of whether you spend that money or not, at the back of our head, we are going to presume that somewhere in your journey as regulations tighten, as governments bring in new regulations to ensure that climate change is something we can tackle, controversial subject no doubt these days, but you've got to think about this. And at least 2 of the companies came back to us after that engagement and said, we found this very useful because you've given us a very clear sense of where we stand relative to the others, and this is something that we will work on. And happy to report that both those companies have actually started to make progress. So I think that's the critical part that we as institutional investors can play, which is to engage with companies and try and drive the appropriate, or let's say slightly more progressive behaviors, and driving the company to think a lot more long term. So maybe I'll just halt at that point on the engagement and hand it back to Sundeep.
No, I think it's Vetri and Navneet. I think I still remember, I think one of the automobile companies which had to come to the mutual fund industry because certain resolutions had to be, and to explain. That tells you how this thing is working well. The whole process is giving voice to the small investors, the small retail investors who otherwise would not have any say. And there are many examples where I think the companies have been working closely with individual investee companies or with directly AMFI doesn't get involved in it, but as a platform, all the mutual funds together. Rather, I think before coming for this, I was just trying to, nowadays ChatGPT helps you a lot. So I tried to get which is one of the most high profile cases, where the whole thing of corporate governance, share activism worked out. It was a very interesting case. Many of us have heard of this. It was BlackRock and ExxonMobil. It was a very interesting case where one of the minority shareholders, which is Engine One, wanted the company to look at the social issues, the various other things, not only look at profits. And BlackRock, which was the second largest shareholder, actually took side of Engine One. And effectively, the ExxonMobil had to change a lot of policies and also had to change 3 directors. So this is the way, how far it can go. But let me again come back to Vetri, since you touched one other thing, that we are always short of, because as portfolio managers, each one of us mutual funds have invested in 500, 700 companies. Whenever resolutions come, they come, same, those for weeks. And we have to rely on the proxy firms, But the proxy firms also have the same problem. I mean, ultimately, they are also short of people. They will have, everything is coming together. Do you think now, the quality of proxy firms in India, does it need to basically go to the next level? And because many times what is happening, all of us have to go to our boards, when we vote against or for or against anything. And most of the boards have a policy, follow the proxy firms. Now, I just wanted your view because you've been, as a CIO also earlier, investing in a lot of companies. How do you balance this?
So I think it's been a process of evolution for us. And in all honesty, I think it's been a process of evolution even for the proxy voting firms. I think they themselves have, come under criticism for the fact that in some cases they have not applied rules uniformly. So increasingly what we are seeing is that many of them effectively have an internal black book where they're able to tell you, look, this is the framework through which we will look at every resolution. Having said that, Sundeep, I think the one point where at least we have always emphasized that it's the analyst and the fund manager we need to take a lead role is on decisions which are very crucially related to capital allocation and to the business itself. Because on the governance factors, we value what the proxies tell us, but on anything to do with business, we tend to believe that eventually it's the investment team which needs to have the stronger view. And we sometimes see proxies come with strong views about, they haven't explained how they will go about building this new business. But that's where, I tend to sit back and say, company to wo chala rahe na. So, we have to make sure that we trust them and that they will do the right thing over time. And we cannot, take for ourselves the control of saying, I will not allow you to do this new thing unless you explain it to me in its entirety. So I think that's the fine line at which you have to balance. And that's the same point that very often we have to explain to the boards as well, that when it comes to certain business decisions of capital allocation and such, we actually tend to be guided more by the management's thought process about what they want to do, rather than trying to superimpose my capital allocation framework on top of them, because I think that would be absolutely unfair.
Vetri, just to make it a little lighter and more difficult for you, you talked about business decision is taken by you. How do you respond to a resolution which comes that we want to build a temple inside a factory of 200 crores and it will be good for business? How do you respond to that? It's a real life, it has happened.
I think that would not pass the muster of something that we would be very happy with.
Navneet, you want to?
No, unless it's a temple of manufacturing excellence. But on a more serious note, I think it was several years back, one of the company highly respected on governance, on business management, everything had a resolution where for a particular project, because of a particular project that they had on the CSR, they were substantially higher than 2%. And we requested that, you should keep it at 2% and then maybe over a period of time, maybe spend that additional money, but otherwise the promoters can do it. And they listened to us, and while the resolution would have gone through given the shareholding, but they really respected that view. But I must say, there's a point I mentioned earlier that the view used to be that we are a minority shareholder till, let's say, maybe till last decade or so. Last 10, 15 years, we have seen this huge evolution and the whole engagement part from the institutional investors like us going up a lot more, and we have a long way to go. But before that, everybody used to vote with the feet because you assume that you are a minority shareholder. Our shareholding was also less. Today, the industry is more than 40 lakh crores in active equity funds. In 2014, this was like just 2 lakh crores. So AUM has increased so much, your shareholding has increased. With that small shareholding, you would assume that you have no voice, right? If you say something, the management wouldn't pay attention. But that's not the case today. Even if 1% or 2% of the investors vote against, it finds a media space, and management is very particular. In large part of companies are very particular that they don't want to have that disengagement. They don't want that negative vibes around that resolution. So I think there is a lot of pragmatism. There is a lot of constructive engagement on the other side also. I remember that because ENS is not the topic, but I used to be on the Asia Advisory Group of Climate Action 100 plus, 161 largest carbon footprint organizations in the world, and 5 of those companies listed were in India, and we were either a lead or a co-lead investor. The first letter kind of to chairman of the board or to the CEO kind of didn't have any response. But the second and third time, and I'm sure many more investors globally would have written, and we saw over the next couple of years very constructive, very good quality engagement that ultimately it is good for those companies to engage on climate change, because the country has got a path towards net zero, country has got certain sustainability objectives, and it's good for their business. The another big driver is ultimately, as Mangar says, that look for the incentives. The incentive today is so high. I mean, you see the valuation from the companies which are like well-governed, who really engage well with the investors, versus the companies who don't. The valuation gap is like very, very high. So that's like another big driver, I would say, for management, for leadership, for boards to engage more, because they can clearly see the impact. But I'll just add that point on voting with the feed. Even when we were like very small and our ownership, you quoted those numbers now, very large number of companies where we own 5%, 7%, we are capped at 10%, and I strongly believe that over a period of time, as our ownership goes up, why say we shouldn't even look at beyond 10%, because we are owning on behalf of crores of investors. We are bringing better governance. Who better investor than, let's say, domestic mutual fund like us? It's good for the country, but that's for another day. As it increases that, I used to tell people that why we need to take it seriously, that we won't have the luxury of voting with our feet as we become larger and larger. And the second, it is good for us. All of us fight for the alpha generation. So we say that benchmark over the last 5 years delivered 15%, we delivered 18%, that 300 basis point is our skill. But I used to say that all of us together can work to increase the beta itself, the market return itself. If together we can work with businesses and nudge the corporate behavior in a positive manner, the overall market returns will go up. The overall economy's returns will go up. It's good for the society, and ultimately it will be good for our portfolio. So there is an incentive for us to look at the economies and the market's return itself. Apart from that, you will get better returns over a longer period. If you extend your time frame beyond the next quarter or next year or two, the companies that are well governed automatically will deliver better value. But in the very long arc of things, that you can actually increase the market return itself. So there is responsibility on us, but there is an incentive for us to do this, I would say, more effectively and with greater conviction.
Really insightful, Navneet. No, it's a very interesting. I think all of us being from the industry, I think we can, many times you have to give a
Can I request, there is a blower of AC which is like
on the head, you know.
Really, yeah.
You still have here, I'm losing air, it's impacting me more, you know. No, but it's really, you know, interesting to see how the industry has evolved, because typically the perception would be, if it's return versus, you know, taking some decisions to, you know, go against the some companies. Today the fact is, if 8% of the resolutions company industry has gone against, and that's a pretty substantial number, you know, and this number was negligible for 5-6 years back. That tells you how mutual fund industry is giving voice to the small investors, but more importantly, to the point that Navneet mentioned, corporate governance from a long-term point of view gives you a better valuation. You have to look beyond the next 1 or 2 or 5 quarters, and things change. And that is what the mutual fund industry has been trying to do. I mean, but if I was to extend this, you know, because the theme is about investors versus institutions, Vetri, I mean, or Navneet, anyone for you, because they don't have an access to this information, they don't have access to this kind of research. But what do you think, I mean, how will they ever be able to, can they ever take such decisions? And if not, what's your advice for them?
It's a very tough one, Sundeep, but first let me just go back to the earlier point you made, because I think Navneet also talked about the fact that, you know, only 5-6% of all resolutions got voted against and 94% got voted for. So a few years back, a journalist called me and said, you guys do a lousy job of governance and voting. So I said, why? He said 93% for and 6% against sounds more like Putin's outcome in the election in Russia. So I said, but that's the wrong perspective, right? This is not a political battle in which we are supposed to vote yes and no. And please keep in mind that if the Indian stock market has delivered an exceptional return over the last 20 years, it's because many of our entrepreneurs have done the right thing over 20 years in the way that they have run their businesses, the way they have, taken their decisions, and, obviously the growth of the economy has helped. So our cases of where we vote against are an exception to good governance. It is not something like a political battle in which you will rarely see one party take 93% of the vote and only 6% voting against them. So first of all, I think that's the wrong context to bring when you look at proxy voting data. Keep in mind that these entrepreneurs have done a great job, and that's why the Indian market has such a stellar outcome over so many years. To your point on individual versus institution, I think it comes back to the same thing, that individuals don't necessarily have agency, don't have the ability to engage with the company, and most probably will not even get an audience with the company because this is distributed small shareholdings. And I think therefore the responsibility is on us as institutional shareholders to build those processes, those teams, those standardized frameworks that can help us engage. And obviously, as somebody who, all of us are running mutual funds, we'd love for more investors to come to us rather than do it directly. Always a choice that they have. And therefore, we need to make sure that when they trust us with the money, we will exercise that responsibility of stewardship and governance, in a wholehearted fashion and with full amount of investment and dedication. So, that's pretty much where I would sum it up.
So, Navneet, do you see, again, some of the global trends, because in India till now, most of the proxy firms have been looking at more from very financial related party transactions, various things. But globally, the social and the environmental aspects have also started coming into the center stage. And the EximMobile issue, what we talked about, exactly that. Do you think that will also come to India?
Globally, you are saying about the activism.
Activism, and especially, the proxy firms are more, right now, related party transactions, KMPs.
I think if you look at the votes against, would be mostly executive compensation. It would be the ESOP policy or structure. This would be related party transactions. This would be some of the board appointments. This would be some of the board powers, so on and so forth. Broadly, these 5-6 items where you would see vote against. But actually, when people look at these numbers, 4.4% voted against, but large number of resolutions are like very routine, right? You don't vote against, like, let's say, financial results or dividend or whatever. Several of those are very, very routine. There are directors who are retiring by rotation, getting reappointment, and they are eligible and deserving candidates. Obviously, you vote in favor of them. I think we are seeing more awareness, and maybe in US, etc., there are also shareholder-driven resolutions, and in between. But there is so much of flip-flop in US and some of the other countries. We shouldn't even compare ourselves with them. 2 years back, there were so many of the shareholder-driven resolutions on the whole point of climate, on DEI, etc. And today, it's a completely different mood. If you look at any of those Net Zero Banking Alliance, if you look at like Climate Action 100+ and all, there was a time when large global asset managers would take pride in saying that we have joined this or we have created this group to support the whole climate change or support DEI and some of these. Today they take pride and they want this to get published in mainstream media, that they moved out of that to please a certain political, I would say, the way which is there. So there has been a huge flip-flop, particularly in US and several of the large financial services groups, as well as the asset managers in US. I would give credit to India. I think we have been a lot more pragmatic, and there is like consistency as far as governance is concerned, right from our policymakers in government, whether you look at the direction in which over the last several years Companies Act has moved, you look at SEBI in terms of LODR and everything. I think we are, and the whole ecosystem of the institutional investors, proxy advisors, etc., a lot more. Yeah. On the activism, I'll just mention one point. And in a country where you know that there is a dominant shareholder, for lack of a better word, on a very lighter, because you made a couple of comments, there is one Lala. That could be That could be a family, that could be government of India, that could be, I mean, a multinational organization. I think, yeah, more or less in these three buckets, you have a dominant shareholder, and then you have like large number of minority shareholders. Within that, the ownership of retail investors, which are like quite fragmented, and again institutional. You have like investors driven by different motives, by different incentives. Several of these days large hedge funds, etc. Their holding period or their motive is very different than institutional investors like us. And also the whole, you have to see in the context of the socio-economic environment, the socio-political environment. And I strongly believe that in a country like ours, constructive engagement is far better than the combative activism that you see in US for no reason. In fact, I keep seeing, you see like all the studies of the average tenure of the CEOs, unreasonable expectations get set, more than unreasonable compensation structure gets set to meet those unreasonable expectations, and more than unreasonable steps are like expected from them, and what is kind of like done both by the board and that. And I think from a society perspective, I think I have more, I would say, respect for, I think, the Indian companies, leadership and board than I would have for some of the people where we look up to. In fact, in my foreword, when we submitted our first ESG committee's report, I wrote that there is so much we can teach the world on ESG, on governance, just by drawing on the civilizational heritage and the ancient wisdom that this country has, than applying from what the West is teaching us. That's for another day.
So Vetri, do you think, I think we have just last few minutes, I think before we open for questions, if there are two domestic institutions, one is taking the role of, and people like us, who are allocating capital, institution A, which is it's doing its role, taking this part of proxy, everything very seriously compared to the other one, which is not, but the other one is giving better returns. Do you think investors are able to differentiate between the two institutions, which is doing the fiduciary role better compared to the one which is giving better returns?
Right now, though, Sundeep, we are still trying to explain risk-adjusted return to people. So we haven't got to the point where we are trying to explain, differences in ESG policies, so to speak. So I think it's very low among the priority of domestic investors at this point of time. And, because we have a global footprint, we see very big differences in this attitude. In our European operations, because we run a large UCITS fund in Dublin, with European investors, it is front and center of all our conversations. UTI AMC is one of the, I think, first 3 Indian AMCs to sign up with UN Principles for Responsible Investing, which is a very large, sort of template of things that you do as a responsible investor. That is still a big point of engagement for us with European investors. But we just opened an office in US, SEC registered last year. Nobody in the US wants to discuss this topic. They literally don't care anymore about this topic. So there's a big difference over there. I would say even in India, if you look at some of the fund houses who've launched ESG schemes, the sort of appetite for that, or let me put it this way, is the investor willing to take a markdown in his return because they think they are getting satisfaction for having abided by certain ESG values that they hold dear to them? We have not come across too many of such investors. So I think, it's demand pull. When our investors ask for it, we are happy to provide that. There's one interesting development that is getting talked about in some parts of the world, and maybe it's also a move to sort of democratize the voting rights down to unit holders of mutual funds or, whatever you call the structure, is to say that you allow your votes to be determined by individual unit holders as well. So very simplistically, if I was a scheme with 100 shares and underlying that there are 100 unit holders, I ask the 100 unit holders, how do you want me to vote? And then I can vote appropriately the number of shares based on what their choices are. I'm not sure whether that is passing the buck and, ignoring your responsibility, or that is a move to say, let the individual investor decide if it's important for him. But this is being discussed, and I think BlackRock is sort of thinking through how it can implement a model of this to allow the individual unit holder in their scheme to determine how the votes will get cast.
I think what you rightly mentioned about Dublin and other some jurisdictions, I think I see the same thing in Japan. I think as Nippon Life in Japan, when it's share an example, it goes to the next level. One is you're investing in a listed company, but that is a different discussion. But there was recently a TV channel where there were some corporate governance issues, and as a company, the decision was taken that we will not be advertising on that channel. So I think it goes to the next level. It's not only basically just whether to invest, keep the stock or sell. It goes to the next level. But I think as we end, before we open up...
So you talked about the Japan and the Europe. Actually, if you look at the flows this year, where they've gone, so it's other than the US, Korea, Taiwan, Japan, China, these 5, 6, Brazil is small amount, but these are the 5. And the underlying theme is the AI. Anything related to AI is where the global money is moving. But another interesting aspect, if you look at the outperformance of Korea, Japan, and China in particular, it's also due to, I think, incrementally what they are doing on the governance side. Japan is a classic example. The whole re-rating of the market after several decades was like that Abe's 3 arrow, which one of them was like all including what they need to do on corporate governance. I mean, all the studies we used to do in terms of comparing India's governance standards with some of the other countries, we found so many interesting things. Like in Japan, hundreds of companies do their AGM on a particular day so that activist investor can only attend one of them. The remaining 899 are spared. But I think that's what they have tried to, and all the, the cross ownership, cross board membership, etc. They are addressing it in a very methodical manner. Same is like at least incrementally, last few quarters, government is making the right noises in Korea and China. So globally, it's important. But I've always said, particularly outside India, that I think what India has done over the last several years is we need to take a lot of pride in that. While we need to remain humble, long way to go, but still, I think India has done a very, very good job.
I think we have time for a couple of questions, from the audience. I think before we end the session, I think I can see a couple of hands going up. 3, 4, 5.
Hi.
Perfect. Yeah. Sure.
Hi, this is for all of you. So I know I've been part of the industry earlier, and you rightly said we can take a lot of pride in what is the distance we've come in representing the retail investor. Do you actually anticipate an opportunity going forward where you actually engage periodically with the investors? I know it's impractical to assume that, investor will vote on each resolution. But one of the things that doesn't happen frequently enough in the mutual fund industry or any financial industry generally is actually speaking to the investors from time to time to gauge a mood of what is it they want their money to do, beyond, getting a good return. If you think about ESG, it came out of that kind of a thinking in the West. In a country where 70% of the households are investing in mutual funds actually go and ask from time to time. You spoke about a flip-flop in America. It wasn't a flip-flop. It was a survival for the fund industry. They had to go back and take cognizance of the mood of the households who were no longer willing to back climate. So do you anticipate that happening in India, being able to go and speak to your investors from time to time as an institution, as AMFI, or as, on some kind of an organized basis?
Vetri or Navneet? Any one of them?
The interesting part was that, fortunately or unfortunately, India didn't follow that whole wave of the ESG funds, ESG labeled funds, not ESG funds. And I think we also avoided a lot of greenwashing and purpose washing, and same funds, and we just label it because there was a pool of money which was chasing where the name is or the label is ESG. And that's where I think a lot of mistakes were made or excesses were made. I think India kind of like avoided that. There were a couple of funds and the money came. But I always say that our endeavor should not be financing the green. Our endeavor should not be financing the green. Our endeavor should be greening the finance. A day will come where all of us don't vote anything negative. That will be like, really, we have arrived. By having this larger number that we have voted, whatever 10% negative or 4% negative is not the right thing. You engage and you reach a stage where we are all on the same side. And similarly on the climate side and all, I think there is a broader alignment in the society, because I think it flows from the top that sustainability is important. At $2,500 per capita, we are poorest of the poor from a per capita perspective, and still saying in a G20 that Vasudhaiva Kutumbakam, whole planet is my family. I won't destroy when I go from 2,500 to 5,000 or 10,000 with 1.4 billion people. We are 18% of humanity, 18% of cattle population. And if we do the same, but we have aspiration to reach that 5 and 10,000, but I don't want to do the same way that every other country on planet Earth has done in last 200 years. That's like a very, very big thing. So there is like overall alignment, and within that, we get like, I would say, we are also fully aligned with that. Your point is absolutely right. How do we explain this part better to end investor? Just like we say mutual fund sahi hai, just like they say invest for long term, power of compounding, don't get swayed by the volatility. This is also an important part, that what we are doing on the governance is very good for you, because if we nudge the corporate sector, if we nudge the business community, the business in the right direction, it's good for all of us. More can be done. You are absolutely right. Yeah. I thought that was your question, right? Yeah. Thank you.
Just to add to that question as well, I think actually there's a fair amount of engagement all of us do with unit holders. You know, there are monthly webinars, some are pre-scheduled. I know at our firm we do 24 webinars a year, which is pre-scheduled. Then on top of that, we've got fund managers who travel to locations, meet with distributors, meet with investors. So there's a fair amount of engagement which happens with, you know, unit holders, distributors, I would say with all these stakeholders involved with the industry to try and get our message out. But remember, at the end of the day, you're talking very large numbers, right? I mean, we have 1.3 crore folios. So it's very difficult to have a conversation with 1.3 crore people one-on-one. You can only use media and, you know, those kind of tools to reach them. And I think digital has been a great game changer, that we can get to your phone and, you know, communicate to you. But I think all of us in the industry do that very extensively.
I think we'll have the last two questions together, because before we came for this, we were told, I think you have to stick to your timeline. The calendar is packed and we are already, it's 4:33. So we'll have the two questions together and then we'll try to conclude it, you know.
May I?
Yeah, please.
Ticklish question. I have seen most of the FIIs and also Indian companies depend on the proxy advisors' advisory on company resolutions than applying their independent mind. Many times we find that, no, we just take it. Their opinion is correct, not correct. They don't apply their individual mind. So what are your questions? What is your opinion on that?
No, that's not true. I mean, that is, that's an input to the decision-making process. There's an independent thinking that the analysts and the fund managers and all of them do, yeah. And there are people who are, sorry, sir?
Our experience has been different, except for a couple of cases, they generally go by the advisory's opinion.
I go back to my friend Ashutosh's words, maybe we need to do more on that part of the advocacy, yeah. But I used to have Ashutosh a slide in my presentation. What's good for society is good for your portfolio. Like why we do this, why we are thinking like this. So you are right, we need to do a little more on that.
So I was just going to extend what got said here. It's very difficult to argue what a proxy advisor says. It's like greenwashing, etc. But all of what is getting published or whatever a resolution is as per what is permissible under the law, etc. All of that is true. Now, within this, when we are measuring one company versus another, the challenge that allocators of capital such as yourselves perhaps have is the number of thousands of companies that you invest in. And when we come back to you to make suggestions, I head up investor relations, I'm also the chief risk officer. When we come to you to explain our position, while we've been measured on a similar scale altogether, how does your investment committee and how does your board think about it? Because there's too much of work for you. And it's much easier to go back to a templatized resolution, if you will.
Did you get the question?
I think question was, can you rely on a standardized template? Am I right? So I think the standardized template is it's like a checklist, right? So even a pilot, when they fly the plane, they have to do, that entire checklist. But then there are some decisions that you then have to look through and say, what's the level of engagement we have with the company to explain itself. So I think the thought process we have always followed is checklist, our template, what's the input, but always ask the company what is your stance on this. And we always vote only after we've got a response from the company. If the company chooses not to respond, then it's a different issue. But we always try and reach out to the company to say, we want to know your point of view. In many cases, anyway, the proxy advisor also get it back. But I would say we always engage with companies on most of these issues where we think there is a sensitivity or there may be an issue which is specific to the company. Please explain it to us.
No, just broadly to add to this point, I think clearly the whole ecosystem is evolving. I think there were no proxy firms, today there are proxy firms. Proxy firms also are improving. Proxy firm, the inputs for proxy firms is basically the starting point for us, but that's not the final decision. So I think that's the way to see it, But I think once again, respecting time,
if it's over templatized, then you are just kind of ticking the box. I think Einstein famously said, everything that can be counted may not count, everything that counts may not be counted, right? And if you say the whole Sanatan or whatever the Indian philosophy is, truth is contextual, dharma is contextual.
So I think would like to just, as we end the session, I think all of us, on behalf of the mutual fund industry, we can share with you. I think we're conscious of our responsibility. The industry is getting bigger. The number of investors, coming from small cities and towns are just increasing. And mutual fund industry is here to give voice to the small investors. Once again, thank you very much, Mr. Damodaran, for having all of us and giving mutual fund industry a voice so that we can explain to everybody what we do for the retail investors. Thank you very much.
Thank you.
So thank you, Mr. Munot, Mr. Sikka, and Mr. Subramaniam for providing very useful insights. We request you to remain on stage. And moving forward, may I now request Mr. V.A. George, Member Advisory Committee Excellence Enablers, to please present a memento to each panelist. So on behalf of each panelist, Excellence Enablers is proud to have sponsored Education for One Girl Child for 1 full year through the NGO Nanni Kali, a Mahindra initiative.